uh, chip supplier bottleneck, meatpacking monopolies, and Wall Street and housing always go well together, right? That's just my little. Okay. 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 Right. Yeah.
You know what? My mic wasn't even on. I got so
Everyone's sitting there
excited. I
just
was
like, what
so
is
in it. I was so in it. Let's do this one more time. Random Rabbit, podcast number 9. We are hitting you guys with some facts, some knowledge. We are coming at you hard. GME. I was hoping. There's Jeremy's smile. There it is.
There's a
GME?
lot happening. It's going to be a great podcast.
We're looking to shatter windows in your mind. Stay tuned. Let's go to topic number 1. Random Rabbit Wyatt, Random Rabbit Jeremy. Are you guys ready?
I'm
Yep.
ready.
Let's do this.
Let's get into this.
All right. So the first topic we're talking about today is the NCAA college player compensation is allowed. So this was a ruling that went up to the Supreme Court, and the NCAA had alleged for a long time that used amateurism as a defense for saying that college athletes shouldn't really be getting any compensation, and that most specifically when it comes to the suit, that colleges as a whole are not allowed to offer additional benefits as ways of compensating and recruiting these players specifically. They did recognize that you have the name, image, and likeness, and they encourage schools to help students make a income on their name, image, and likeness. But they said that there was collective agreement that the NCAA said that all the schools cannot offer specified benefits and compensation. Well, the Supreme Court ruled that is no longer allowed. It's not a requirement for schools to do so, but it is saying the NCAA cannot make this a mandate and cannot have all schools collectively not doing this. If a school wants to offer compensation and wants to offer some type of benefit to these players, that they can do so. They're no longer restricted from doing so. And the big part of this is that it's not pay to play, right? So it's not that NCAA athletes now are making salaries for playing in the game. No, it's they have to be tied mostly to education, and this includes things like scholarships for graduate vocational schools, internships, computer equipment, study abroad programs, and limited cash awards for athletes, potentially totaling $6,000 for performance in the classroom, right? So it's not just a pay for play. They're not getting, a salary like an athlete. But one of the big things that was alleged here, and it was said by Justice Brett Kavanaugh in one of his in his analysis afterwards when he wrote, he said, traditions alone cannot justify the NCAA's decision to build a massive money-raising enterprise on the backs of student athletes who are not fairly compensated. Nowhere else in America can a business get away with agreeing not to pay their workers a fair market rate on the theory that their product is defined by not paying their workers a fair market rate. And why is it so important? Is because this college sports is a multi-billion-dollar industry. Mr. Emmert, the he is the president of, I forget his first name. He's the president of the NCAA. He makes about $4 million a year annually. And conference commissioner, school athletic directors, even some of the top coaches, they make multi-million-dollar a year salary. So when you look at this billion-dollar industry, they make profit right on these athletes, and these athletes are extremely limited in what they can be paid for, even though they're playing normal regulation long games and regulation size fields, following all the rules. The only difference is they're not on a professional team. But colleges will use this, and the NCAA use this to bring in revenue, to bring in fans, to bring in recruiters, to bring in students, right, to bring in traffic and donation, as well as different types of endorsements. So it seems like a fair, at least from my perspective, it seems like a fair decision because they're not paying them, they're not giving them a salary. So it's not, it's not decentivizing going to school and getting your education. But what it's doing is it's saying, hey, you're going to play this sport and you're going to work really hard at it every single day, and you're going to represent the school and you're going to bring in lots of revenue. schools can provide more benefits and compensation for you, especially at least in this form of getting things for education. So it's more of a windfall for them, more than just their name, image, and likeness. Because some of these athletes, they get picked up by major companies, they get picked up by major TV networks that make commercials and stuff. So their names are known, just like professional athletes are, and they're watched and tracked in the same way. So I think it's definitely a step in the right direction. And the NCAA could be looking at some more antitrust style legality issues down the line, because really the NCAA sets all the rules and policies, and they've been under fire for some time for these kind of weird defenses and this whole concept where it's like, listen, you're amateurs, and if we pay you, it's no longer amateurism that can't be maintained. And the court said no, it can still be maintained. Schools can compensate them with benefits if they want. The NCAA cannot uniformly require that all schools collectively cannot do this. So Supreme Court set a precedent, big one.
That's good. Most of these families need the money, and especially when these athletes are coming from a lower income bracket. I don't see anything wrong with the athletes getting paid what they need to get paid in order to get through life, help out their family, and most of the time these people, NCAA athletes, don't even get into the pros. So why not help them out now? Because only a very small fraction of them are even going to go pro and then get paid the big bucks.
Right. If you're gonna benefit on their hard work, and there's such a small chance to actually make it pro anyway, then you might as well compensate them for their effort, especially when you're making millions of dollars running this program.
Schools are making bank.
These are your employees. Basically these are the employees and the revenue drivers. If you're not paying them, well, why should you deserve all this money?
If you're working them to the bone like horses, and you're trying to be like, okay, I'm going to pay my coaches millions of dollars. Well, pay the people who are actually doing the work the money.
Right. Exactly. These are because without them, there's no revenue.
There's no
one
sport,
cares. No one gives a damn about your school if you're some D3 or D4 and you're not getting national coverage. You're D1 athletes. You're getting tens of millions of dollars a year in terms of revenue from those individuals because of your sports programs. They should be compensated because you're benefiting. Everyone else in the system is benefiting except the people doing all the work, right? So it's just, I think it's a step in the right direction.
All right, sounds good.
All right, so the next topic is a chip supplier bottleneck starts hitting consumers, and there's general risks throughout all the supply chains. So as we know, component shortages have been driving up prices and things, everything from computer chips, silicon, copper, right? All the components needed to build things, especially building technology. And DigiKey Electronics, one of the U.S.'s largest electronic component distributors, raised semiconductor-related components the price roughly by 15%, with expectations to go up to 40%. So we're definitely seeing technology increasing in value. So we've seen places like Dell, Microsoft, even Apple, their goods on Amazon, their goods on different marketplaces are slightly increasing by 2%, 3%, $50 here, $60 there. And the inventory index, which is a measure of computer chips available in the market, if January 2020 is the date where we ping it at 100, right? We say the value at this point was 100, so we can use it comparatively to as of yesterday, that was under 20. So almost 80% of supply has been diminished, and this is for two real reasons, right? One, when people were gearing up to work from home, supplies were inventories were emptied because people were buying all the time. They want to prepare for this work at home, this new kind of tech way of doing business. But at the same time, then you had the supply chain shortages. So it limited the amount of supply that was actually available, how much you could get and how fast you could refill your inventory. And as a result, when you add a chip shortage to that, you then have we can't even make these products to begin with. So it puts an even further strain on that supply chain. And one of the biggest things is microcontrollers. These are things found in everyday gadgets. These are things found in appliances, even cars, especially when we're talking about electric vehicles and autonomous vehicles. These microcontrollers, which are basically like small brains that help operate all the internal components, they're becoming much, much more expensive. And the reason this is so concerning is because there's a company called the Taiwan Semiconductor Manufacturing Company, or TSM is their ticker. And it makes almost all of the world's sophisticated chips. By one measure, it's about 92%. They make 92% of the world's sophisticated chips. And the sophisticated chips are used in the most complex technology, which as of today, right, as we go forward, we see the technology only gets more and more complex. So the demand for this is only going to grow higher. It is currently the world's 11th most valuable company with a market cap of $550 billion. And the issue here is that this industry, building computer chips is a very capital intensive industry that you need to spend lots of money on. The average capital requirement to start a single factory is around $20 billion. So this is not something that you just kind of jump into. There's very high barriers to entry. And when you have one company that produces most of the sophisticated chips and a lot of the simpler ones as well, you create a very bad problem, because if most of your stuff comes, they say don't put all your eggs in one basket. Well, we get all of our chips mostly from a series of individual companies, but with this one being probably the biggest and most important of the bunch. And the U.S. right now does still lead chip design and intellectual property with homegrown giants like Intel Corp, Nvidia, and Qualcomm, but that only accounts for about 12% of the world's total production, when back in the 1990s, it was about 37%. So we definitely have a very large reliance on companies that are not part of the United States and other parts of the world. And what is really interesting is that Taiwan right now is being heavily disputed, as China thinks like, oh, that's part of us, and we want to, there's been talks that we want to absorb that and bring that part of the country. And that puts it at odds with the United States. So it's also in a really weird position, even though there's no thought that China would ever really want to endanger their own chip supply, right? And no conflict, just nobody really wants to risk it. It still puts it in a very precarious position geopolitically as well. So it's all the things add up. It's like if something happened to them, right? If there was a fire, their factory went down, like that would be, supply chains would be just like non-existent. So definitely something to watch for. And these bottlenecks are expected from a bunch of different individuals. They estimate roughly to persist through 2022. So we definitely are going to be seeing supply chain bottlenecks down the line, and chip shortages are something that we should be worried about when it comes to tech. Expect your tech products to increase in value, and expect it to possibly be, especially as we get to holiday seasons and stuff, expect that we might not be seeing as much tech to buy. There might not be as much supply out there. So, and we'll kind of see how this develops. But for now, definitely very interesting of how much concentration of production there is in such a small, very specific part of the world in one small specific company. So
Interesting.
I mean, I definitely was looking at graphics cards earlier in the year, and they're ridiculous. I mean, hyperinflated, and I wasn't going near it with a 10-foot pole, just because it wasn't worth it, especially right now. And is this because most of them are using it for crypto mining?
No, in fact, one of the biggest strains was in autos, because now you're seeing huge demands. They had contracts signed out for like a year or two as all these electric vehicle manufacturers, everyone wants to produce this way, and everyone's pushing really heavily into it. But then they're like, listen, we don't really have that much supply. There are plants and manufacturing lines that have actually gone down. They furloughed, I think Audi furloughed about 10,000 workers. One of the major ones did, for one of their factories, because they realized that with the chip shortage, they weren't going to be able to produce all these things. They couldn't keep the doors and lights on because they weren't actually producing things they could sell. So this could be, and this is one of the factors that comes into electric vehicle markets and stuff like that, is when you're pricing this stuff in now, right, over the next few years, you have to compensate for, well, how much of this can still be maintained given the chip shortage? How fast can they get these products out to the market? How much can they develop when we have these problems? Because as the world gets more complex and needs more microcontrollers, everything needs it. Computers, phones, cars, appliances, anything you use. And the more and more we buy and the more and more we want and require, the more demand there is. Supplies are currently low, inventories are currently low, and the supply chain is having severe problems in general. Not to mention that now we see a lot of consolidation, just a very few entities able to actually produce this supply. And one other thing is that TSM does expect to spend about $100 billion over the next 3 years to expand its production capability. So it definitely wants to ramp up and get bigger. But this is interesting to note, because when we talk about why this industry is so hard for people to break into, that $100 billion that they're going to spend represents almost 25% of the entire industry's capital spending, just by them alone. So it's a tough industry to break into, and I think we're definitely going to see some supply constraints, and prices are going to reflect that going forward.
Sweet. That's definitely something to look forward to in the future. And
yes, I'm looking forward to my expensive technology.
We all love expensive technology.
From the sound of it, it sounds like they're also going to be making exclusive chips specifically for one project or another, so that one particular market like gaming isn't going to be affected by crypto, and crypto not going to be affected by electrical vehicles and smart cars and everybody else using these technologies. So as the need increases, so will supply, but also the utility will be specialized and specific.
Right. I think we would need to diversify into more specialized companies because in general, like they just have a huge demand for chips, period. So I guess it really depends on what contracts at what times were filled out, who has priority over these chips, right? If your company has negotiations or deals where they get priority over somebody else, that would probably be good for your company. But I think just as a whole, we're going to see those impacts in terms of projects being delayed and investments being changed, and products being more expensive. And, as we get over the next couple of months, we'll be entering into the holiday season. You know what I mean? Like
Yeah.
this, we're talking about, things. We're talking about Christmas. We're talking about Thanksgiving. We're talking about Halloween. We're talking about the holiday season into February. So if you have big supply shortages going over the next 6 to 8 months,
Right now is the time to figure out how to match when the supply is going to increase.
right? If you promised people that or if you have kids, you promise them you're going to buy them this great new technology, you know, if you
Think
really
twice.
did and you really intended to follow through with it, then you should definitely maybe look into seeing what's available now, and not hoping that in November they'll still be like all these computers to buy because it might not be.
So
They,
remember
they
that.
might not be.
Remember that, audience. Oh, hey, topic number 3: meat packing monopolies.
Right. So, in general, right, the kind of antitrust legislation has been a macro theme. We've seen it really heavily in tech, but there have been a lot of complaints through for companies alleging that there's a lot of influence on the markets and the farmers because most of the beef and poultry markets are really consolidated among some giants like JBS, Tyson, Cargill, Smithfield. Just really a couple of names control 60 to 70% of all of those markets. And what it does is it creates, the argument is that it creates competitive harm to the farmers because they can buy from specific people and not buy from everybody else, and it's hard to get them to be paid. It's hard to get them into the markets, and they have this so-called tournament system that is used by chicken processors to determine how much farmers are paid for raising chickens. Shows the needs for reform. He says under the system, farmers compete against one another on payment, with the most successful earning more for their chickens, while less productive farmers earn lower pay. So it makes sense when you think about it from a free market perspective. But when you think about how many subsidies there are into the agricultural businesses, they want to try and push a minimum standard price and force companies to buy most of their cattle and their poultry on open markets. So instead of creating these competition systems where they basically make everyone compete and the winners get the most money and the losers don't, even though they put in the time and investment to grow their operations, they're saying we're going to try to make it into a more free open market system where you're going to have to buy on a general open market, pay a minimum price across the industry. And legislators are pushing some subsidies for this, about $4 billion program to strengthen the U.S. food system. So the government does want to bring in some aid to help this happen. Right? They don't just expect these companies to make those changes, but there is definitely some action going on here. And this is about a $213 billion industry. So with the size of this and the amount of control they have, it's very interesting that they're coming out and saying that this should be changed and that they want to make these companies make these big changes. So it's definitely something we should look for if you're invested in these industries or in these sectors, or you're invested in these companies. Watch out, because I think a macro theme that's happening now across every industry as well is that the government is going to be looking for monopolies. They're going to be looking for people that have uncompetitive practices. They're going to be looking for people that have price control, and they're going to come after these companies in a way that tries to limit their ability and break them up because they want to perceive more competitiveness down the line. So this works great for the companies. Like, this system works very well for the companies. They get good prices. They make lots of money. But for the farmers and growers, they're making substantially less in profit, especially over 2020 really exacerbated this, when there was a shortage all over the place. The farmers are making far less than the companies who were still posting profits during that time. And if farmers, right, can't maintain their operations, that creates a problem because that will hurt the supply chain as well. And if they go out of business, it's not just something you just pick up and start, right? Getting all the land, getting all the machinery, getting all the feeds and the animals all set up, getting all your regulations and stuff like that, establishing your connections. Like, it's not a simple thing to do. So definitely something to watch for, especially if you're in these sectors. But I think we're just seeing a general theme of antitrust, where we'll be seeing governments, especially the United States government, taking, I think, a look at everyone. So if you're a big company that has a lot of different diversified portfolio of assets across many different markets, maybe you're next. So, but definitely meatpacking is coming under fire.
Okay, sounds good. We already talked about some GMC.
Let's do it.
Let's talk about the markets. All right, so first thing that comes to mind in this whole GameStop frenzy is the first hedge fund to bet against GameStop. Not one of the first ones to bet against them. They're the first ones to default, get liquidated. They're closed. They're closing. This hedge fund, London-based hedge fund, White Square, is shutting down after losing from betting against GameStop. At the peak of their they're at 440 million assets under management with losses. They wouldn't admit what their losses were, but we just know it was in the double digits percentage.
Would have to.
Other hedge funds that have lost plenty and they actually admitted to their losses. Malvern Capital, they shorted GameStop back in January. They lost more than 50% of their fund. They received a $2.75 billion investment from Point72 hedge fund and Citadel. They're still in business and they're still down year to date 44.7% as of last month, May. So that's pretty interesting to see that these guys, good for Melvin. They're bringing it back. They're trying to bring it back, but they're still down a lot and they still lost a lot of money. Another hedge fund, Light Street Hedge Fund, also down 20.1% for the year for the exact same trade. These guys still think, hey, we can short GameStop and not get hurt. There's another hedge fund a month ago or a couple weeks ago. They shorted at when GameStop was 167. Proud of it, sent their investors letters saying we short GameStop at $167. Right now, it is at $220. It went up today 10%, and I don't see it stopping with NSC 002 coming into the mix with the automated margin calls, and more to come about that when we talk about what is happening right now in this market. So the next thing on the list is President Biden called SEC president, the Treasury Secretary, Federal Reserve Chair, all together for their first meeting. I don't know if they say that it was a routine meeting, but this is following the worst week in 8 months after the Dow Jones just took a nice, beautiful hit last week. So is it routine? Would they say it's an emergency meeting? They're saying it's a routine meeting, but I'm going to think otherwise. The other attendings were the acting director of Consumer Financial Protection Bureau, the chair of the Federal Deposit Insurance. Let's just say these are the heads of the SEC, FDIC, the options. All these guys are coming together. And this is what the White House had to say for it. They said, well, the regulators reported that the financial system is in strong condition. They further indicated that financial risks are being mitigated by robust capital and liquidity levels in the banking system and healthy household balance sheets stemming from fiscal support and the ongoing economic recovery. Now, liquidity, we know there's a lot of liquidity. We see that from the reverse repo market that just hit today at another record high of $791 billion. Yes, they have a lot of cash floating around, and guess where they're putting it? They're giving it to the Fed. The Fed is going to give them that money back tomorrow because these are overnight repos, and the Fed's also going to give them an award for that, 0.05% or 5 basis points. That's around over $370 million. Just as we get stimulus checks from the government's helping these institutions, giving them millions of dollars. Why? I don't know why. Because, well, I could take a guess. They know they are in a tough spot because we can see that the reverse repo rate, the overnight reverse repo rate, is more enticing than the 1 month treasury bill, than the 2 month treasury bill, which both of those are at 4 basis points. Then the 3 month treasury bill, that's at 5 basis points. So why would somebody wait for maturity months out when they could just get the money overnight for maturity? The government is trying to say these guys are in a tough spot. They need help. They're stepping in to help in. And yes, they are right. There is a lot of liquidity in the market. And we're going to figure out why, whether it's the easy way where they tell us or the hard way where the market crashes. And this is going to be an ongoing occurrence. And I don't believe that these reverse repo rates are going to go down anytime soon. You want to know something interesting? The last time well, 2008, let's say there was an emergency meeting, but they're not telling us about it. Well, the last time there was an emergency meeting was 2008, September 12th, where all these guys came together. And guess what? 6 days later, Lehman Brothers went bankrupt. The whole market went topsy-turvy. And on January 4th, 2008, they came out with an article that Bush said, the market's strong and solid. Everything's fine, people. They're not going to incite chaos and tell us that the market's shooting like blanks over here. They're not going to say they don't have ammo. They're going to say everything's fine. Liquidity's great. We all have money. The market's going to be fine. So, it's just something to think about. Let's go on to
here are the articles right here. Here's the one from 2008, and then right after that,
the conditions when they met in 2008, they were meeting because the market conditions had deteriorated significantly. Lehman Brothers failed after taking on tremendous amounts of debts and not really acting on them, and then wiping out in the repo market when it comes to trading between banks. So what the SEC, what Joe Biden is trying to do is Joe Biden right now is trying to have the SEC require companies to put in their financial disclosures their exposure and activities when it comes to climate change, in addition to inclusion and other cultural changes.
Financial inclusion and everything like that. So
it could have been, it may have been an emergency. I don't think it was an emergency meeting. Me personally, I think they were just meeting. And I think Joe Biden brought all these people because if you're going to make those requirements of companies, you're going to need to have all the big heads of all the regulatory bodies on board. And you're going to have to ask them, how do we do this legally? And when you think about making big changes for climate, they probably had a conversation with, we have a big plan for infrastructure. We have a big plan for addressing climate change, economy in a good spot to do it. And that's what they're saying.
Pretty fishy that it was after the first week of a very bad
week. The bad week was because the Federal Reserve Chairman, Jerome Powell, came out and said, we expect to raise rates twice by 2023 as opposed to 2024, which is always, the markets always take a hit because inflation usually hurts equities and the entire market revalues itself. People were rearranging their portfolios. The Dow was up again, a couple hundred points today. So I think we are nowhere near the territory of market declines we would need to be, I think, for an emergency meeting of that kind. At least not yet.
We'll see what's going to happen. I would say with the reverse repos so high to record high, that is precedence to have an emergency meeting.
Well, I don't know if it's but it's an emergency though, because I think the banks are just, why would I wait 3, 6, 8 months when I could get 0.05% every single night? Don't think of it as like a systemic problem. Think of it as if you were a banker, right? And you had the opportunity to make money, and you had to park your capital outside of the bank because you don't want to hold it on your balance sheet. Well, the Fed gives you a nice place to do it, and then the Fed has that capital overnight to run operations because the Fed can use that capital and then has to give it back when these guys give back their collateral that the Fed gave them. So it could just be, this has been done before the federal funds rate window, and having liquidity right now I think makes sense when you're still talking about how much supply chain constriction there is. We don't have our labor markets back to full, and the arguments are we're still trying to tolerate a certain amount of inflation. So
yeah, I wouldn't have minded them continuing this reverse repo if they didn't just bump the reward up from 0% on June 17th to 5 basis points. I wouldn't have minded. They could park their cash wherever they want. But I don't believe that the Fed even gave us a reason as to why they even bumped them up to get awards, to get that 5 basis points.
Maybe they don't want them investing in treasuries.
Well, they, with reverse repos, they are getting treasuries. They're getting,
but they don't invest in, but they're trading. They're not like, they're not buying treasuries and holding them as assets on their books. They're trading with the Fed in a temporary.
Yeah,
right. It's a trade. It's not. They're literally like, we'll hold this while you hold that, then we'll give it back. It's mainly
with an award.
Well, it's interest. It's not.
Yeah.
It's a very tiny.
They were doing that at $500 billion at these reverse repos with 0% reward. What gave them the precedence to say, hey, we're going to start giving you a 0.05% award?
Well, the Fed funds rate has this is the lowest it's ever been. Still, 0.05% is still the lowest it's been in a long time.
We're still in a recession. Do they think the economy just got better overnight and said, well, we could give money to the banks now.
Well, but when you're in a recession, you generally see more funding activity because you want to make sure there's liquidity. Because during a recession, people don't have money. So if the banks can easily make that percentage, they can backstop their deposits and they can backstop all their activity. They have more capital to use. I
Well,
will admit that I don't
apparently,
understand
yeah.
why they're doing it at this point, but I don't I think that's because we don't know all the information because we don't know what the liquidity requirements are of these banks or what they're doing with all this capital.
I mean, as of the meeting, the banks have a lot of liquidity on hand, so it has nothing to do with liquidity. It's something else. It could be collateral. It could be just helping them out because they're in a tough spot. But as of their meeting, the White House said, "Hey, the banks are fine. They have a lot of money." So we're gonna see what's gonna happen. News on GameStop. GameStop just completed a 5 million at the money share offering, raising 1.1 billion dollars. The stock jumped up today 10%. Tomorrow, NSCC 002, the automated margin calls. It's going to be interesting to see who gets margin called first. And once we see hedge funds, just as the ones we were speaking about, closing shop, it's going to be a domino effect. And all these other guys with their failed to delivers and their over shorted positions are going to get hit. On Friday, the Russell 1000 inclusion of GameStop, that's going to be another thing where we saw the other day the on balance volume. It's been no one's been selling, but yet the market, the stock has been going up and down. So we're going to see a lot of buying pressure on Friday from the inclusion on the Russell 1000. And let's take a quick look at market beat to look at the short interest data. So we can see that the short interest over time is in January, it was up to $4.14 billion. Then they said, oh, the short's covered. There's only $842 million of short interest right now. Then it started going up February, March to 2.7 billion. And then it went down again. And now it's going up again. What is happening here? Those are called trying to cover your short positions, trying to cover your failed deliveries, and now they're getting caught. And now this recent F13, this recent report that came out for short interest from FINRA shows that there's actually more shorts to be covered, $2.66 billion. And I don't believe that's even the middle point. I think there's going to be well over $4 billion of short interest to cover.
So, I mean, all of this has been leading up to pretty much what you've been trying to predict as analyst, right? As someone like, hey, you know what, the potential of this happening because of said short interest ratios and because of how hedge funds, betted against GameStop. You've been saying, we're just waiting for hedge funds to start shutting down. As soon as hedge funds start shutting down, what's going to happen next? You've been saying this for weeks now, and this is incredible that we've been able to track the development of this. And this is only just the beginning, right?
Yep, this is only just the beginning because the hedge funds are the small fish. Now the SEC has rules for defaulting parties for these institutions. And they have these wind down rules that say, hey, if everything gets defaulted, follow these rules. And now they have a new rule about the auctioning parties saying, all right, well, before we were only able to have a small group of corporations and companies and banks and everything like that to buy up these defaulted parties. So now we're going to make this rule that includes a larger party, more institutions, so that when these institutions start to default, other institutions can buy them up because there's not going to be a government bailout this time. At least I hope not. But they're now including other institutions to buy up these companies for auction when they default.
Well, you have to understand that when the government bailed out, they bailed out banks. They weren't bailing out hedge funds in 2008. They were bailing out the banks that backstop them. So there wouldn't probably be bailouts because these are these are private
Like
companies.
Citadel is too large to fail apparently, but if they are a party that gets taken out and defaults, there's going to have to be
Well, what
like
makes them too
other,
large to fail?
well, they have 50% over, well over 40% of all market traffic going through them into the market. So they control, along
For
with
all
Virtu.
investing,
Yes, this is
for
for
specific
investing.
stocks.
No, this is for all the stock market, for the United States Stock Exchange. This is why it's a duopoly. Citadel and Virtu have the majority of traffic going to those two entities, and they are choosing to either put it into the market or who knows what they want to do, but they have too much power. And it's supposed to be an easy free market, and that's why we need more competition, because those guys are the two main guys who get all the market orders and fill them.
Well, remember when it comes to, which is why there's a big question. We're about to go to break. This is about to end.
So let's present the
I'll say
question,
this
and
one.
we'll answer it after the break. So what's the question?
Oh no, it's not. It's not a question.
Oh.
I was just gonna, yeah. It's not a question.
Yeah, I was trying to build up
Make a
suspense.
statement.
All right, guys. What we're going to do is we're going to take a little short break. If you guys have any questions, go ahead and drop them in the link. Drop them in the comments section. Let us know what we can explain what's going on. Right now, this is going to be something exciting. And so we're definitely going to come back in a few seconds. Be right back.
What you're concerned about, but
Uh,
I appreciate your concern.
and we are back live.
I'm very tired. That's why I may look very passive. But the point I was going to bring up here is that even though Citadel and Virtua control a large percentage of let's say pass through, right, for trades through the market.
Should we start the podcast?
Yeah, I started.
No, we are.
Are we live?
We're live, right?
I said we're live.
Josh, you gotta do the flailing. You gotta let us know
the verbal words were said out loud.
I don't. That doesn't work for me. I'm a visual kind of guy. I gotta see lights and sounds, audio,
There
visual.
we go. There you
go. No, but my point is, if Citadel and Virtua control a lot of the pass through for trades going into the market, do they use that in a way that hurts other companies or investors? Because when you say something has too much power, you would say, okay, if I'm the pass-through and I have a monopoly on that pass-through, then I may charge higher rates or punish other individuals, right? They may just be because there are many other of these companies. They just don't have as much traffic through them as they do. So I would ask, is there? So I guess Josh, it is a question. Is there a threat to the investors or to the brokerages that is posed by Citadel and Virtua having so much of that passed through them? Because if the argument is they shouldn't be investing in large short positions, I agree. But that alone, but just having them be big and powerful wouldn't be a reason for them to be removed, right? That would just be a consequence of market forces, unless they were using it to cause harm, to create a pricing scheme, right, or enact an undue amount of influence in their business.
So let's look at that link I just put up from qz.com.
Where'd you put it?
On it.
Do I have it?
Yep.
It's up.
So when we scroll down and we see where the majority of the volume U.S. stock trading market share by venue,
Right.
the volume's going through the NYSE, the Nasdaq, the Chicago Board,
Right.
Citadel Securities is next. Then it's Virtue at 9.4, and then G1 Execution. Let me
Right. Right.
just tell you, they have way too much power.
Well, then would you
And
argue that the NYSE, Nasdaq, and CBOE have too much power?
no, because they don't have an entity that trades. They're not a hedge fund. Citadel has multiple hedge funds under them, in which
Right.
they have way too much market data to help them out and know where the majority of these trades are going.
Okay.
Same
But
with, and I'm not going to, say that there's market manipulation occurring, because we don't, like, from their end, that, but we can deduce that all that data can, it's like saying, hey, here's $100, there's an ice cream truck there, and you gave it to a kid 5 years old. You think they're going to get ice cream? It's very tempting, but but I can't say if they're going to get ice cream or not, because I just left the house and who knows what's going to happen until we come back and Papa SEC comes in and says, hey guys, you guys have been doing fraud. There's been a lot of market manipulation and now we have proof. So we're going to see what's going to happen, but too much power, too much data in the hands of Citadel and Virtue. We need to diversify that amongst
but
multiple market entities.
well, but what we're looking at on the screen here shows what 6, 9, 12, 15 of these entities.
Exactly.
So
But
what
the
you're saying
larger
is you only
percentage,
want to take Citadel and Virtua and have them broken up into multiple entities
yes. Because
because
are we fighting against the NYSE? Does the New York Securities Exchange have their own hedge fund? No. Are
I don't
we
know.
are we
Don't they make ETFs? Don't they have to have somebody?
does
I
the
wonder.
Nasdaq?
They do. They have funds, but they're like total. They have. Well, hold on. Let me see. Let me see. Let me see. I'm not. I mean, okay, I understand what you're saying, but I would say that that
And
they can have
there's this.
multiple business models, and then maybe one of their business models is fraudulent. Because again, it doesn't have to be the entirety of their system. There could just be people who run those couple of hedge funds that have figured out a way to play this game. But all of the broader Citadel securities, they may just be doing underwriting activities. So
Do you remember? I wish I had this right with me, but I remember showing you
yeah,
the
the reverse
trading
repos.
between GameStop on this site for the month on FINRA, I believe, and it showed that the majority of trades were through Citadel and then Virtu and then other entities, and then
Yeah,
the majority of trades for April and May and March, and the majority of trades for GameStop were through Citadel and Virtu. They didn't say NYSE. They didn't say anything. That would have been a better example for me to prove my point that the majority of trades that are being placed into the market is by those entities.
well, through those entities,
Yes, through those
right?
entities.
So that's why Citadel wanted to be a primary dealer because they wanted to basically be in every part of the market. Um, so, I mean, I agree that you might want to separate them, but you'd have to prove that they were using that data for that reason. Like, I definitely think there was some sketchy behavior there with using their repos and the potential to have that capital on their books. Um, but just as a pass-through entity, I don't think leaving Citadel but that percentage would be a bad thing. I think maybe you would want to spin off the hedge funds, perhaps maybe separate them, just like you do separating banking and other certain industries. So you force them to only focus on one silo of operation. I could definitely see that. But I wouldn't say you'd break up Citadel and make two different venues to do the same thing because that part of Citadel
Oh
might be
no,
valid.
no, no, no. We don't want to just break up Citadel and make them two different entities. I want to make sure that there are hundreds of broker dealers out there that are able to fill to the market. I don't want just one and then say, oh, there's another one, so it's fine. No, I want hundreds, because we need to make this a level playing field. We don't need to keep seeing this pay for order flow. We don't need to keep seeing all these ways that they can use this market data. We need an efficient market. And the first step to doing that, along with all these other SEC rules that have been coming out, a very big step would be diversifying the power of who gets to put the orders into the actual market. It would make our bid-ask spreads much, much lower, and we'd be able to get filled at way better prices.
Sounds
Maybe.
good.
Maybe.
Sounds good. Was that your last topic for today?
Yep, that was the last topic for.
So then for
market.
people who are just jumping on, GME up 10%. Do we see this as the end or beginning of this rise?
Oh, it's begun since January. I've been looking and following this whole thing, and it's barely in the middle, and it's just about to begin. I'm predicting that it's going to start hiking up. 220 is just the beginning. It's already had, 3 run-ups and fallback downs. The ETF, which there's an ETF over here, XRT, I remember talking about it, and I'm going to put it up for you. XRT, I remember last week, and I'll put the link right there. Okay. Last week we saw XRT. It was shorted at 160%. Then we saw it go, and it got shorted at up a percentage to 180%. Now it's shorted 218.53%. How is this still happening? How is XRT, which is the retail sector, retail ETF, still being shorted?
I have no idea.
It's like they're not stopping, and they're just trying to get their last breath in before all these rules finally start, like tomorrow. And when 005 finally gets fully in effect, everything is going to start coming full circle, and we're going to know who has the actual shares and who are the borrowers of these shares.
So tomorrow's a big day.
Naked shorting is hopefully going to cease, and we're going to see more data. So if we don't see it this week, just know that within the next month, it's going to be a bloodbath, and we're going to see how much GME is actually shorted. What is the actual short interest in this stock? And let me say, it is well over, from my perspective, well over 140%, because the only reason they ever say, well, it's short 140%, that's because the SEC actually capped them off from putting in the document that you can short that 140%. Anything over, you can't say in the documentation that it's short over 140%. They capped it off at 140. I'm thinking that it's well above 140. I'm thinking that it's in over 200% shorted.
Why did the SEC cap it at 140?
They probably thought, well, 140 is a large amount to short a stock. If anything more, people might find this and say, hey, we're going to take the opposite trade and push those shorts out the door, out the house. But they didn't even want...
But if the SEC, think of it this way, right? The SEC passes a rule and you're not allowed to be more than 100% short of a company. So why does the SEC say you're not allowed to report more than 140%? Why does it even allow it in the first place?
Exactly. They shouldn't have allowed it in the first place. They're too lackadaisical with their rules. And we thought we learned from 2008. Why didn't we bring up these rules that we're finally getting in 2021 back in 2008 and afterwards? Because we knew naked shorting was illegal. And they knew it was illegal. And that's why they said, we're stopping the practice. Guess what? It's still been going on. We're finally getting the rules that we have needed in this whole game of financial markets. Because let me tell you, it is a game that they're playing, and they play it at a high frequency trading game, and they make all the money, and they mess up the whole institutional foundation for retail. Do you even believe that have you believed we're on a level playing ground with these institutions?
No, obviously not.
Never. No. But this is going to bring the playing field that much more closer to a level playing field. And, as Michael Burry said, people are asking him, hey, what's happening in the financial markets? He just says, the largest financial crisis we have ever seen is occurring
I can tell you
right now. Larger than 2008. We thought we couldn't get as bad as 2008. No, it's worse. And we're going to see it all across the board. Commercial real estate market. Who knows if hopefully the retail market doesn't get hit again. But let me tell you, if the banks go down, everyone goes down. So it's all across the board. We're going to see a lot of pain.
This is what you've been talking about for weeks and months on end. This was one of the biggest driving factors of creating this podcast. There's so much news. Ooh, that was a little weird.
Very nice.
Air come out. There's been so much news around this, and all of this is, let's be honest, this isn't in the public eye. This is kind of like your guys' ability to view this news and interpret it in a way that's going to reflect what Jeremy said is, it's not the repeat of the past, it's the rhyme of the past.
Yeah, history doesn't repeat itself, it rhymes. But at the same time, it's only been 13 years since 2008, and it's repeating. That's why, I mean, I've been trying to see when the market's going to crash, why it knows everything's overinflated, everything has such a high valuation, it's unsustainable. And we've been waiting for this market crash, and COVID has accelerated it. And these Redditors, these people who are backing GME because of these naked shorts and the fraud, everything is coming together. Even the commercial real estate sector, with people saying, "Oh, your business, you want this building, you want this business building. How much do you make? Oh, 100K revenue. Well, just say on your sheet that you make $1 million revenue, and then you can have this business." When that goes topsy-turvy, belly up, there's going to be a lot of foreclosures in the commercial sector.
Man, exciting news. Any thoughts or predictions on what might happen next? I see this all as a domino effect. One thing's coming after the other. What's going to be that next block hit?
Hedge funds.
So that's where that first hedge fund shutting down was so exciting.
Yeah, and it's just the beginning. And in the news article they said, well, they lost a lot of money, and then their two largest investors, they backed out, and that's why they are closing. And then they're going to reevaluate and see if they could open up again. But they lost a lot of money. Then these next couple days, I'm telling you, tomorrow's a very exciting day with this automated margin call system. I don't think you guys understand that they're going to do liquidity checks right then and there. You want to know something interesting? Now in the options market for these institutions, when they hold options, they need approved liquidity 2 days before, lock up their cash 2 days before for their options positions. Then they on options day, that's a very important day. 7 days after, they still have that cash locked up. So they're in a world of pain. Now they have to really think about, okay, for these options positions, we have to have the cash on hand in order for us not to get liquidated. That's a new rule that came out. And level playing field, we're going to see a lot of chaos in the market, and I'm pretty excited about it.
So for anybody who is wondering what it means to have liquidity when you're making your options, or when you're is it calls for options? What's the proper terminology?
Options are
when you're making
derivative
options.
Product,
Mm-hmm.
and a derivative for one contract for a call option is worth 100 shares of a stock. and you're looking at, let's say you have Apple. You have Apple at $100. So you buy a call option at the money for $100, and you're betting that it's going to go up. So this call option is going to go up, and it could be for a week maturity, it could be a month maturity, it could be a year maturity. Depending on the maturity rate, the length of the contract, it's going to go up in price. There are these Greeks in there, and we could go into that later for more financial segments, but they get pretty complex, and usually options is a losing game, because the longer you hold that contract, the less value it has. So you need to be smart about it. You need to look at volatility. You need to look at the time maturity, and there's just a lot happening. But what I'm waiting to see in this whole GME is when another gamma squeeze occurs. And that's going to be the first thing. It's not going to be a short squeeze right away. It's going to be a gamma squeeze. And that's when these market makers need to buy up more shares, because the stock price goes up from $100, and let's say you have 1,000 options, call options at $105. Well, once the price goes from $100 to $105, you got 1,000 contracts now in the money. Well, guess what? Per one contract, that market maker now has to buy up shares in order to keep both sides of that trade neutral. So they're not over leveraged. So the market makers now need to buy up these shares in the market, increasing that price. And so it's going to be, and that's what's called a gamma squeeze. When that occurs, and let's say 20,000 contracts become in the money, the market maker needs to quickly become delta neutral, buying up more shares from the market, and it's just going to skyrocket up, and then boom, 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 and you're just going to see it hike. There's a lot of strategies in this market. There's a lot of rules, and we're going to see GameStop. I don't doubt they're going to try any more manipulation. I hope these rules stick and help us out, but I don't doubt it's going to go up.
That's great news. We will be intently waiting to see the result on how all this is going to play out. Thank you so much for the analysis. You guys ready to jump into crypto?
Let's go for crypto.
All right, so from one wow, goodness, I cannot talk today. So from one bloodbath to another, let's talk about Bitcoin. Bitcoin today loses $350 billion as it sinks below, losing 15-30%. Now, this all looks bad in the short run, but if we look at the charts, we're actually only going, we hit the floor for the year. From what it looked like, it looked as if it dropped down to pretty much a 0% yield per year. And as we look at this price, we're going to see, well, let's just continue. Bitcoin erases all of its 2021 price gains. Here we are. Today was a brutal day. If you were looking at this and you were just watching it, I'm pretty sure you were crying if you bought up near $60,000. Now, here's the beautiful thing about crypto. Crypto bounces. And when it bounces really, really hard. From year to date, today, it climbs. Not only does it lose its money, it climbs an additional 15% on top of that, recovering. You guys can't be sleeping on crypto. Bitcoin, this isn't surprising. Bitcoin is either going to drop hard or it's going to bounce hard. It's one or the other. And as we see, people are just waiting to get to the floor in order to grab in at the lowest cost and grab that bounce back up. Now let's look at this, how it looked like throughout that day. Now, if you're looking at it today and you woke up in the morning and you're saying, hey, look, you know what? The price still looks pretty good. Um, as we continue throughout the middle of the day, we just dip. We hit below 30,000. Now this was to be expected. This might not even be the bottom. We're looking at a potential floor of even 18,000. Will that happen? It could not. Could this be the last floor? Can be, cannot. This is part of the game of crypto. You have to. The risk is there. What you have to look at though is large institutions are looking at this price and they are licking their chops. They are drooling from the mouth because 6 months ago, 3 months ago, this was not the price of Bitcoin. It was around 60,000. Everybody right now is looking at this and seeing this as a potential long-term hold. If you want to get caught up in the short term, you know what? You could have made 15% today. Catching this bottom, we have, it's now increased to 16% since I last checked it. Look at this chart. You do not see this in the stock market. This is unreal. And so you guys have to remember, when you're in this market, you're not in it to buy and sell hard. You're in it to hold. If you're holding, you're going to be losing less money, right? If you're looking at this and you're saying, you know what, I want to sell here, and you're getting that FOMO, and then you see that it drops here, and you go, you know what, I got to sell. I got to sell. This is a natural mentality. Nobody wants to lose their money. Nobody wants to see their Bitcoin drop. But be reassured that the momentum immediately picks up and builds back again. From that, we're gonna keep looking to see what Bitcoin's gonna do. Bitcoin is usually the leader in these things. After Bitcoin comes Ethereum. After Ethereum comes the rest of the altcoins. That's been the pattern. Are we gonna see it this time? That's the real question. Everybody's saying that this is the crackdown of the miners. The miners are utilizing different technologies. I just recently read that they're going to look to try to recycle coal waste. And they raised $105 million in order to go that direction. There's a lot of people trying to solve this problem and issue of how much it costs in order to mine and run Bitcoin mining. I do see solutions coming about in the near future. How is this going to affect the price? Well, right now, miners leaving China, they're selling. This is the price drop we're looking at. People are trying to get money for their Bitcoin because guess what? They got to move. They got to leave. They got to relocate. It's time to cash out. That's all fine and dandy because you know what? As soon as mining picks up again, what do you think is going to happen to the price? Hopefully it goes back up. And I say hopefully because you can't predict this market. Look at this. We just hit back up to 34,000 while we're live.
It's a volatile market. High risk, high reward.
This is
cryptocurrency
nuts.
goes up, cryptocurrency goes down. It is crazy. That's why you got to know the game and know that bounces bounce. When it goes up, it goes down to consolidate, and then it goes back up again.
So, for the next part, people have been asking me, you know, what are some of these cryptos that have taken the biggest hits? What are the ones that aren't just, crap coins? They're not shit coins. These are the ones that have actual value. Which ones took a big hit? And as I continue with this list, this isn't financial advice. This is what's been observed, what I've seen as a high over the last 6 months, and what I am shocked to see it drop immediately that have great potential. Let's start off with number 1, XRP. XRP is now back down at 60 cents. XRP is one of those unicorns of the crypto world right now. Right now, it is hard to get your hands on XRP, but that's because they're still in the lawsuit against the SEC, and they're still finalizing that. But even
Yes.
in the midst of it being in the middle of the SEC, it still went up to $2, right? It went up to $1.60. I think it was had a I do remember $1.60. I'm not sure if it kissed $2. Um, we'll have to come back to that. But actually, let's just check the price. XRP price. $0.59. Now, if we look at this in the last 3 months, we hit one. So we were coming close to $2. Everybody was looking for that $2 mark, but we hit $1.81. Now, XRP has real world applications. Their ability to make transactions at the speed that they're able to do it with a low cost transaction, low gas fee, that's what's going to be pushing this potential cryptocurrency back up. But if we're looking at this, you better believe over the last, let's see, it drops down to $1. This is the price where I started saying I need to get back into this. And as it went back up, you see the volatility. It's playing a sideways market right here for at least, I want to say that's maybe a good month. And then we have a drop in coin. So right here, we're looking at one potential of pretty much a coin that survived the last bubble, the previous bubble. This is a coin that's been sticking around. And so none of this is financial advice. I'm just pointing out what's going on. Another one that's competing with XRP, Orchid. Not a lot of people are talking about Orchid, but Orchid does have the potential to compete up against XRP. It's now dropped back down to its 20% range. That one's looking good. Stellar was hitting crazy numbers this week. Stellar hasn't been this low since, I think, last year. So let's look at Stellar Lumen. In the last 3 months, I believe it hit close to, I think I want to say 81 cents. Let's see. 70, and let's see the year. And in the year, okay, we got close. We got up to 70 cents. XLM has its potential. This is another one of the OGs. This one's been surviving year to date. We're still looking at 100% gain in percentage and returns. And that's saying that Bitcoin has gone down to 0 and returned back up to 16%. These are still strong for the year. Where it will go, well, we're looking at the last bubble, and we're seeing that it's either going to go away or we're going to have a beautiful pump. Stellar's a beautiful one right now to look at. As we go down the line, wow, there's just so many good ones. One that was shocking, that made a huge presentation in the last 6 months is going to be Civic. Civic went and its price exploded. This was a coin that looked like it was dying a year, 2 years ago. That is not what I want. Honda Civics, that's funny. Here we are. We're looking at Civic. Let's look at the year. Civic reached, this is the one that reached 81 cents. Unreal. These are ones that before this whole pump, Civic was under 10 cents, right? Let's see where we're looking at. Right before November. We're looking under 10 cents. The growth of these are just ridiculous. A lot of these that I'll be talking about are going to be a type of Ethereum token. And just to be out there, Ethereum is definitely a cryptocurrency that I do see as having strength.
I want to see your take on stable coins, because all these charts I'm seeing look like pump and dumps, and that's just the game of cryptocurrency. There are a lot of altcoins, a lot of these coins out there, and you can see a bottom of where it starts, and at the end, we're seeing a consolidation period where we're going to finally see a floor, and then it's going to stay there for a while, and then it's going to go back up. But I want to know which coins you believe are stable coins that at the moment they're going down, and then later on gonna hike back up, and because of their backing.
So the ones that I see as stable coins are going to be the ones that have some real world applications. Some of these that I'm looking at are going to be Cardano. Cardano has come out with their own wallets, their own transactions. They're making leaps and bounds in their ability to come out with their real world application. Cardano is one of them. Let's see, as we go down, it's really on how the market plays. It's the use of the technology and how applicable they're going to be in that time and period in its thought and projection of the future and how it's going to play out. So a lot of these protocols are being made, and the hype comes in when it says, hey, you know what, as this grows and goes into the future, this protocol sounds like it's going to be really, really good. Now, a month, 2 months, 3 months go by, other people are now creating similar protocols, creating similar cryptocurrencies, and challenging and making better financial protocols for the market. And so right now, competition is really strong. Some of the other ones, I know Ethereum 2.0. Ethereum 2.0 is coming out. I was reading an article saying that is Ethereum 2.0 going to be a Cardano killer? Those are great questions. Those are great questions because I'm looking forward to Ethereum 2.0 and I'm looking into the future of Cardano. Are they going to be competing against each other? I think that's going to be what we're going to continue talking about as we move forward. But right now, the market has been dipping. This is not a game for the weak. This isn't, you need to have a strong stomach when you're looking at these things. But you also have to see the potential. Remember, if you're purchasing up here, I'm just going to say, you potentially messed up. At the same time, if it does drop this low, don't sell. You can do whatever you want, but you already lost that money. In your mind, remember, stocks pump again. Not stocks, cryptocurrencies pump again. And not only do they pump, they look to try to beat their previous all-time high. And that's what's consistent about this market, that if there is a recovery, that recovery bypasses, blows right through what that previous ceiling was and creates a new all-time high. Once you start seeing it pass its previous all-time high, don't think it's going to go to the moon. Look for conservative investment risk tolerance that you have planned, that once it's gained a specific percentage, pull out. Remember, be happy with your gains, not with what you think it's going to go. Because if what you're looking at is like Dogecoin, let's look at it right now. This thing is an ugly chart. And then we'll go to another ugly chart of Shiba coin. You want to see pump and dump? This right here is a pump and dump. With previous markets, and let's just look at Civic. This is over a period of time. This is periodic. This is pretty common. If you reflect this potentially towards the Bitcoin chart, you're going to see it most likely follows the same pattern as it rises and falls. Now we look over at Dogecoin. This is a pump and dump, guys. You're not making an investment choice. You're making a bet right here. You're making a gamble that you're hoping, hey, I'm going to put my rent into this and become a millionaire. I hope you do. I really, really hope you do, because if you think you're going to become a billionaire purchasing at 64 cents when everybody who actually is a millionaire purchased before the new year and even into January, those are the guys who became millionaires. Remember, it's about getting in early on these markets. It's not about sleeping on these markets. If you're still looking at Dogecoin and you're holding, I saw a guy show his portfolio today showing $300,000 dip in his account. He made all his money in Dogecoin. I believe got it up to $1 million. And today he's staring at his account. Loss of $300,000. And this man is not selling. Diamond hands are in this market. Why? I don't know. I really don't know. But right now the price is slipping. This one's a really high risk. I can't say that it's going to pump back up, but sure golly, everybody does. Everybody wants this sucker to pump back up. I wouldn't touch it with a 10-foot pole. Instead, I touched it with a 12-foot pole, and we'll see how we ride this one out. The last crap coin is going to be Shiba Uni. I think I always spell that wrong. It's Inu. This is going to be another example of a pump and dump. Let's see what we're looking at. And so if we look at the 1 year, boom. This is ugly. Guys, this is not investment. This right here is the lotto. Just like Dogecoin. And this coin came after Dogecoin. This is what we're talking about as not being an investment. This is not following the market. This is following hype. This is following people wanting to get rich because after Dogecoin made its debut and was making stupid amount of money, or making people money who made the investment in it before it went up, other people started seeing this market and saying, you know what? We could just put a cute name and face to any of these coins and throw it out in the market and say, like, you know, Elon Musk has a Shiba dog now, and look, that increased the value of this cryptocurrency. That's what's going on. None of this is real investing. This right here is another gamble. Pump and dump. These other ones have been in the market for quite some time. We have Civic. Let's go over to Cardano price. Cardano is another good one. The reason I really like Cardano is because it hasn't been so affected by this drop in the market. If we look at Cardano, we have to the year, as we see everything drop up, yeah, we see a head and shoulders here, and then a bit of a sideways market. Now, this sideways market has been where all markets have just been crashing and going down. If you're looking at Cardano as a long-term hold, the momentum is still there. Everybody is still seeing, and this is just because the utility behind it is still strong. We're looking at a good project. And as this continues moving forward, and I have to continue saying this isn't financial advice, do your own research. This is looking good. This is looking like something I'm going to keep holding. And so what we're going to do is we're going to just take a short little break. And if you guys have any questions, come on back. Give us a comment. Give us what you guys understand, don't understand. But this right here, this is where money's at. This is what's pumping. Guys, we'll be right back. Coming back soon.
There you go. There you getting it.
All right, guys, we're back. If we're coming to the end of this podcast, if you guys joined us, thank you.
Yes.
You guys are the real heroes. We want you guys to be informed. This is all news that's happening right here, right now. This is all real time. All this information is gathered day of. These guys do a lot of research in what they're bringing. Subscribe to the channel. This is just the beginning. We're going to be covering this market. We're going to be covering this GME short. We're going to be covering crypto. We're going to be covering news, economics, stocks. These are the things that you guys need to be keeping an eye on, and we're here to make sure that you do. Guys, it's always a pleasure talking with you guys. Any final thoughts?
Always a pleasure. No?
Everything was good.
All right, guys. Watch that podcast. Come back tomorrow. We'll be live again, 9:30 Eastern Standard Time, 6:30 Pacific Standard Time. I'm not sure if that's how you're supposed to say it, if you're supposed to switch it the other way around. But we will be back, guys, and we will be covering the effects of what's going to be going on tomorrow with the implementation of the new rules. This is Random Rabbit Jack, Random Rabbit Rem. This is Master Rabbit. We are signing off. You guys have a good night.
Peace, everybody.